Okay, perfect. So, my bad. I was a bot. Just trying to get this shit to work, but now it's recording. But, anyways, what I was basically explaining was what I'm going to be doing is kind of going through a little bit of a series of just basic fundamentals and kind of where to kind of focus your attention along the way of just being able to position yourself into the market, right? So, one thing that today I'm going to be really focusing on in particular is just going to be our institutional areas, right? And really, with this, like I said, this is going to be kind of a series. So, this is going to be part one, right? Institutional areas, right? Just areas where ideally the banks are going to be just getting in and out of the markets. Okay, so how we're going to be able to identify just certain institutional areas, right? The institutions, obviously the banks, right? The main liquidity providers. What we're going to be focusing on is just how to validate an institutional area, because I feel like how many of you guys right now kind of like struggle with that, like finding the right place to maybe enter? Like sometimes you guys just don't know which, down push before the up move, which up push before the down move, right? If you kind of struggle with that, I feel like that was probably one of the biggest things that I struggled with when I first came into the industry with as well, was just understanding that, because it's very difficult. As you guys can see, there's a lot of the similarities in the markets, and it just looks all the same. It's just like, oh fuck, like this one looks like one, but then this one looks like one, but then this one looks like one. It's like, how do I know, right? So you're never really going to know, but what you're going to be able to do is start to increase the probability of you being able to actually get activated into the market, but not only get activated in your position, but also be profitable. Because how many of you guys want to be able to find positions, but also make money, right? Because how many of you guys would rather skip the finding positions part if you guys are not making any money? Because I know I'd rather skip finding a position if I know I'm not going to make money, or if it's not going to be as probable as simply waiting maybe for a few other things, right? So, with that being said, the first fundamental when it comes down to institutional areas is we need to be able to identify them on different time frames. So, the reason why we need to be able to identify them, oh shit, sorry. You guys are not really missing much on the sharing screen. I'm just kind of writing down the shit, right? So institutional areas, right? We need to identify them on different time frames. So what does that mean, right? Let's take this particular area, for example. Let's just use a relative range. So I use this like often, right, when I describe just particular areas in the markets. So what a relative range to me is going to be is just things that are relative to price action right now. So it's like there's a lot of the times we mark up areas, but they might be on the higher time frames. So if you're marking up an area, for example, on the daily, what you have to expect is it to take days to get to that area. On the weekly, weeks. On the monthly, months. So now what we have to sit here and start to do is identify maybe the 4 hour, maybe the 1 hour range that we're in. Okay, so I'm not just talking about just today's price action. I'm talking about find the high and low point from the last couple of days and look to see if there's actually a trading range created. Like look to see if there's actually a high and low created, right? Within the last couple of days. So ideally, you want to find trading range. So there's going to be different trading ranges, obviously based off of the different time frames. For this example's sake, we're literally using like real price action, right? We're looking at the 15-minute time frame right now for Bitcoin, okay? So what we have to sit here and we have to do is first identify, okay, where is our trading range? So for me, immediately looking at this is kind of how I would start going about it, right? So I would take this high right here from Wednesday and this low right here from Friday, right? The reason why I would do that is because to me, right, we need to look left to get right. So if I look left, right, and I'm able to really just identify everything that took place over here. All right, let's go go to the hourly for a sec, right? To just identify everything that happened over here to the left, right? What happened over here to the left? Well, the same type of thing, right? We created a little bit of a range where you see us kind of trade sideways. Like, do you see how this high point and this low point, we're not there for very long, but in between, look at the in between. You see this sideways, this up and down, this consolidation, right? This is how you find your trading ranges, because what's going to happen is trading ranges are going to create liquidity, right? We're going to create highs like we did right here, and we're going to create lows like we did right here. So you have to pay attention to what gets swept, because in this example here we see big impulsive pushes down, captures all of the lows. Then immediately we see a push back up here, right? We get a pop, we fail to break above in terms of structure, and then really continue to consolidate, and then what? You see here, what do? We generate more liquidity, but more importantly, we actually run out this low. You can see that we get this wick below. So that means anybody that bought in here would have had their stop loss hit had they broke even, or had they even just had their stop loss slightly below. Okay? So when it comes down to institutional areas, this is where a lot of people will kind of get hit out and they'll be scared, right? But this example I kind of like a little bit better because like we have this smaller time frame accumulation. But if we really were to sit here and just look at this price, right? Based off of our trading range, right? We'll use this as an example instead of like the relative price action, just because, like I said, the accumulation I want to show you guys. I didn't really look at this, but to me, I could already look at it. I could look at this and just see, like, we're good. So this is our range, right? Looking at it from the hourly perspective, we can see that hourly wise, right, with this push up, we captured the liquidity of anybody who sold early in here, right? So now what we can do is say, okay, right, we got one of those confirmations in terms of what we look for in terms of the market, right? We look for that liquidity capture. Now it's being able to identify the institutional areas, right? So ideally what you want to pay attention to, like I said, is that last sweep down or that last sweep up before we make those big impulsive reversals. So if we were to sit here, right, and I were to just look at this, a lot of people would really just mark up this candle, right? They'd just be looking at this candle. You can see in this example, right, it worked out, right? We played off of this candle fairly well. But for me, what you really have to pay attention to is this whole area, okay? So yes, you can say this is that last up candle before we broke down, but what you have to pay attention to is the start of the last push up. Because where do you think the buying starts? Do you think the buying just starts at the climax, or do you think it starts at the bottom? It's going to start at the bottom, right? So when we sit here and we look at this, we have a lot of orders generated in terms of sell side liquidity. We have a lot of people that could be selling the market. If they're short in the market, where their stop loss is going to be, right? Above this resistance that they see forming, right? So you notice how prices just consolidates, and then all of a sudden we get just 4 or 5 consecutive candles to the upside, then this breakdown, right? So now if we sit here and we look, okay, we have 3 big impulsive pushes to the downside. Overall, with seasonality, any impulsive push to the downside right now, this time of year, you should be looking for buys. Okay, so just based off of the seasonality of gold, you have to understand crypto and gold are really going to be doing the same thing, right? They're the safe haven. Like if crypto's going up, obviously fucking dollar's going down, right? So what we have to sit here and do is correlate the seasonality with gold with just what crypto should be doing. And if you go back test crypto and you go look at crypto for the last maybe like 2 or 3 years, 4 years really, January to March, like March is literally when we start running. Every year. Like literally, I bought crypto every year for like the last 4 years in March. Why? Because that's when we've already created bottoms for maybe the next 6 months, maybe the next year, right? So what we have to sit here and do is apply fundamentals from other markets that are similar, that correlate, maybe not perfectly, but just correlate in terms of overall direction. Like if you really go back to Bitcoin and gold, it's like you're going to see they do the same shit. For the most part, they do the same shit. Like if I'm short in Ethereum, I'm gonna be looking to short gold too. Why? XAU USD, ETH USD. Like what? Why else are we dealing with it other than the fact that the US dollar is attached to it, right? So now that we sit here and we identify, okay, right, this is the hourly time frame that we're looking at. If we sit here, right, and we just get rid of even all of this, right? So we just look at this now. Right, we've identified our bigger range, we've identified the liquidity. Now let's dig a little bit smaller, right? Let's go to the 15 minute, right? So if we go to the 15 minute now, or 30 minutes, sorry, we see a little bit of a different story. Okay, we see a little bit of a different story, right? The reason why I switched to the line graph is because now we can see, right? If we look at this price right here, right? So if we're looking at just this lower high, right? When we came back up over here, did we close above that previous high? Yeah, right? We closed above, right? Let's bring it a step down, right? Let's go to the 15 minute. So now we go to the 15 minute. What do we see? Similar thing. The 15 minute broke above, right? Just whatever structure we had here. Okay, so now just identifying that, what we immediately want to do is just look back at price and really identify, okay, where's the money resting? If we look at this from the perspective of non-bias, right, just looking at it for what it is, right, we could see that we had liquidity built up here, which got captured with this big impulsive candle. So notice how we have this quick, big impulsive candle up, right? 2 candles. All of a sudden now we've captured like hours of price action. But notice how on the flip side, what did we leave? We left equal lows. Okay, now if we take it a step further, right? Where was the start of that last drive down before we flipped and we actually broke structure? Because the 30-minute structure, right, you could kind of look at the structure break a little bit higher, but 15-minute wise, to me, as soon as we closed above this right here, that's a 15-minute break of structure. Okay, so to me, the reason why, this is that last lower high, right? This is that last area where we whoop, pop back up, trap more buyers, and then whoop, dumped. But notice how we break above this structure, right? To me, the area that you're really going to be looking to target as your institutional area, these last 2 candles. So what you have to do is find confluence within these 2 candles, or whatever your institutional area is, right? And look for fundamental places where the algorithm should come back and fill, right? So just immediately looking at this, right, what do we have here? We have the liquidity, right? So we have liquidity here, right? Could really say we have liquidity here as well. So we just have a bunch of equal lows there, right? Now if we dig this down a step further, right, and we really look at the 5-minute. Okay, now we look at the 5-minute, 3-minute. Are there any insufficiencies? Nothing really. 1 minute, nothing really. Like, there's no real insufficiencies to me that are crazy enough to the point where it's like, okay, we really have to come back. To me, the only thing I could really see is this right here. Right. So we have this little small insufficiency here. Besides that, right, there's not a lot that really we could come back and fill, right? But the way that I used to really play my positions, right, is from the 15-minute perspective. Like, I used to fib my candles, right? And now to me, it's like, I don't really have to fib my candles because, like, it's, like, mental. Like, I just know, I basically, like, it's just, I see it, right? I don't really have to do it. But realistically, this is how I kind of used to go about finding my institutional areas. So I would find those 1 or 2 or 3 consecutive candles, right? I would sit there, right? If we're looking for buys, right, we're going to fib from bottom to top, right? And I know you guys probably never seen my fib levels before. I feel like someone was asking me the other day for my fib levels. But realistically, these are the fib levels that I use, right? These are not my fib levels. I got them from one of my mentors, right, who really kind of like tweaked around and played with these for a while. But for me, I'm personally not really going to enter the market unless we're at a 0.786 and below. So I look for a 0.76 and below when I'm playing ranges. So I'm going to show you how to fib your range, and I'm going to show you how to fib like the candles, right? A lot of people don't fib their candles or fib their areas, but it's like this is what I do, especially on gold, because what you guys have to realize is gold is going to come back up to the 100% more than you guys like would expect it to in comparison to maybe other pairs or other currencies. So that's why, like, this really applies mainly on gold, right? So maybe the fibs are not going to work as well on Forex. To me, it still does. That's where you're going to get the, like, most stupid risk to reward ever, right? Because, look, a lot of times, people would sit here and they would look at the 100%, and anything below the 100% is, all right, that's not a valid entry. The 110%, what you have to understand, is designed to run liquidity. That's where the stop runs are. So 100% of the range, 110% is where liquidity is going to be getting ran. So 115% sometimes is going to be the best place to enter. So imagine being able to get something on sale for 115% off for 2 seconds. It's like that's the equivalent of what the market does for people. So what we have to sit here and do is identify, okay, the sweet spot. So most people, the area that they play, right, they play the 50%, right? So we'll label this, right? There's no brown, so we'll do green because, you know, to me, that's where the shit entries come. 50%, right? That's where trash entries come, right? So 50%, right? The green, right? Sweet spot, to me, most days going to be right here. We'll do that sweet baby blue. Feel me? Right? But then this is where I like to call your yellow tapes, right? If you're a Toronto man, you know about the yellow tapes. This is the yellow tape entry right here. This is literally your yellow taping, right? This is going to be liquidity being ran, right? So now that we sit here, we fibbed our area, right? We have a couple of these areas marked up. Now what we have to sit here, and what we have to do, obviously, we let price kind of play out because we had that liquidity generated right there, right? So if we look at this, right, immediately where the green is, that's where the 50% is. That's where the shit entries are. Right? And you have to notice how there's liquidity that generates, that builds up in this area. So now in just perspective to our institutional area, right, which are these 2 down candles, 15-minute down candles, right? The reason why we established is because we closed above, once we pushed above here, that's when we actually broke 15-minute structure. So when we break structure to the upside, what we have to expect is a retracement back down. When? Who knows, right? Because what we can see, right, is as price continues to develop, we just start to create more and more targets, right? So immediately, you can see that as price develops, we create equal highs here. So notice, right, we're bullish. We're looking for buys. We're looking for price to go down. What is price now doing? It's creating targets on the upside. So it's creating targets for us to take literally when we go back up, right? So that's ideally what you want to see start to happen, what you want to see start to generate. Because if you're looking for buys and you see equal highs get created, is that not good? Because that's liquidity. The way that we trade, that's liquidity. That's what you want to see happen in the market, right? So as we continue to just break down, right, immediately, right, we have this institutional area. This is our sweet spots of our institutional area. But if we were to break it down, I'm not really going to go too deep into what imbalances are. But to me, we have an imbalance right here. Right, that's going to be another week. That's going to be probably next week. We'll go through imbalances, maybe the week after. But like I said, it's going to be really a series. So with this, we have our liquidity here. Right, this white area is not only in confluence with an imbalance, but also if we really sit here and kind of pay attention, we had these last 2 down candles before we actually pushed price up and broke that 15-minute structure. Right, so the potential to see a pop out of there makes sense as well, right? So now you have to understand, I want you guys to all write this down, right? The transfer of wealth in the foreign exchange market is simply from the inpatient to the patient. So that's like literally when you lose money and you donate your bread in the market, you are donating to somebody who's simply just way more patient. So when you blow your account, you have to think about it. Somebody's sitting there and they're hitting take profit on the same trade you're blowing your account on. So you have to just learn to be patient. Sometimes the best trade is no trade. That's why I say, like, nobody forces you to fucking get into 7 retarded positions in a row besides your emotional self, right? Not your analytical self. So we have to establish which one is which when you're trading. Are you emotional or are you analytical? Because emotions is going to be what sometimes fogs your sight, right? So as we see price develop, right, we can see what happens, right? So boom, imbalance fill, cool, break back up. This is where people get crazy and people start to feel like, oh my gosh, like I missed the entry. So this is where people now, right, the transfer of wealth in the foreign exchange market is simply from the impatient to the patient. So those are the people that are going to be making the most money. So right here, right, immediately we see this imbalance, cool, filled, perfect, right? What do we end up doing? We really create the same type of inefficiency imbalance in this white box now, right? But notice a lot of people are going to start scaling their positions up, right? So we identified our trading range, right? So now I'm going to show you how to fib your trading range, right? This is our low where we got this 15-minute breaker structure. But this is that last area where we drove up, captured all of this liquidity, and then broke down, captured all of this liquidity to the downside. Right? So this area is relative to our range because this was kind of that last high point, right? That was the last valid high that we created before we dropped down. And now you can see, obviously, we came back and tested it, right? So if we were to sit here and we were to look, like I said, for buys, what we're going to be doing is we're going to be looking from fib, like at the bottom to top, right? And if we look at where the 100% of our range is right here, right? So now if we create that yellow tape zone, quote unquote, for our range, our yellow tape zone is actually a little bit deeper, right? So this is why I say price is relative to whatever time frame you're looking at it on, right? Because now if we look at the 100%, the 110% of the whole range, it's a little bit different than 110% of just the institutional area. Okay? So now that we look at this, right? If you were to looking for, let's say, shorts, right? You would have simply just fib from high to low. And notice that where we came into, right? Where's that sweet spot that I talked about, right? That 100%, really that 78.6. To me, I really like the 0.86. That's kind of like my favorite besides the 100%. 0.786 to me is where I'll take that if shit, like it's a big area or something like that. But to me, I like to see as deep of a push as possible. So if we were to just look at this, for example, right, the difference between risk to reward, let's say if you just take it off the 0.86, and let's say you have your stop loss right above the 100%, right, your first target, let's say, obviously we took that liquidity there. So now really where majority of the liquidity is resting is no longer on the upside after we took all of those highs, but it's actually on the downside, right? So if we were to sit here and kind of look at this from a risk to reward standpoint, targeting just that first batch of liquidity, it would be about a 1 to 4, right? But where most people would sit here and they would sell, right, they'd be looking for sells in here. And it's like if you really just look at perspective in terms of the range, right, this is why a lot of you guys be losing. It's because you'll sell at the bottom of a range or you'll buy at the top of a range. And it's like, once you do that, that's when you get stuck into the market because it's like you typically end up doing that when you miss. Like, have you guys ever like wanted to buy or sell and then you were scared to, but then you tried to get in late and then you end up losing because you got in late? I feel like everybody, right? Laura's like, yeah, right? It's like that happens to us all, right? So what we have to understand is how we can avoid that from, how we can just help avoid that from happening is by sitting here and, like I said, cutting down our risk. So if we sit here and we just look at this, right? So the area that we're really looking to target for buys is down here, right? So our first yellow tape area looking kind of like this, 1 to 11, right? That 15-minute one looking more something like this, right? So all of this is relative to change as well, because let's say like you could set it to enter on like the 100%, but it's like, let's say you're super savage and then you sit here and it's like you wait for it to come all the way down here, or you wait for it to push a little bit deeper. It's like that's how you can kind of tweak your risk to reward a little bit to make it more favorable for you to be able to not have to trade so much, right? Because if you, let's say you up your risk to reward on the same trade from, let's say you're looking initially at a 1 to 5, but you're able to cut down the stop loss and you're now able to turn it into a 1 to 15. It's like if a 1 to 5 was your target for the week, and now by you doing the same thing and having the same target, having that hit, but you chopped it down to a 1 to 15, you're done for the next 3 weeks now. You don't have to trade for 3 weeks. So it's just being able to just do things like that by looking at the market from this perspective, right? So if we just look at price, right? Notice how as soon as we get this first initial push into here, right, we pop down, we come back, right? We come back. So it's like price is always going to be able to give you opportunities to kind of get in and out of the market because look, right, we initially, let me get rid of the fib to make it a little bit easier to see, right? So initially we were looking for shorts in here, right? And notice how this box, it's like these magic boxes, right? Just poof, we wick into that, we feel that perfectly, right? This is where a lot of people are going to be getting baited into buys, right? It's not to say that we can't fly from here, but it's like, to me, like, there's no way that we just bounce perfectly right off of this imbalance liquidity right there too. It's like we didn't even capture the liquidity, right? We just made more liquidity, to me, if anything, right? So looking at this, right, people would kind of be looking to buy, but what did we already establish? Where would this be in the range right now if we were to buy right here? Would this be at the bottom or at the top or in the middle? In terms of buying, it would be more in the middle to the top, right? To me, it's more the middle, but ideally, it's the top of the buying range. You really wouldn't want to buy there. It's the top of the buying range, right? So with this, it's like if we sit here and we just look from low to high, you know, this is a potential 1 to 5, right? Still nonetheless. So if we get to this high, but looking at how price plays out, right? It's like immediately, right? We get this pop, we bounce up. Then just seeing all of these consecutive candles to the downside on the 15-minute, that's your red flag, right? What you want to see, if a valid institutional area is there, whatever time frame you're looking at, you're going to see 3 to 7 candles in the direction that you want the market to go in. So the reason why this is a valid institutional area, how many candles do we get to the upside here consecutively? 1, 2, 3, 4, 5, right? We get 5 in a row, and then what? A little bit of consolidation, right? We get 3 to the downside, but it's like you have to just pay attention to how large the bodies are, right? So in comparison to these sell candles, right, the buy candles are bigger, right? And there's only 3. Then by the time we get to that third one, we stall out, and then what? 3 consecutive candles to the upside, right? 3 consecutive candles to the upside, right? 4 consecutive candles to the upside, and this is where structure actually gets broke, with these 4 consecutive pushes. So that's the one thing to pay attention to. Institutional areas, you're going to know it's an institutional area when you see 3 to 7 consecutive candles on whatever time frame that you're looking at print out of that area. So if we're looking at the hourly, you want to see 3 to... If you are entering on a daily time frame, you want to see 3 to 7 daily candles print in your direction to know that you're right. How do you think I've been holding trade since November? The first 3 days, I knew that I could hold it from November till at least now. You think it was an accident? It was a coincidence? So, now that we sit here and identify, all right, cool, middle of the range would have got clapped, right? The first area where we get that little bit of a reaction, and notice how as soon as we capture liquidity, that's when we get bounces every single time, right? So that first area of liquidity, in here, right, as soon as it gets captured, boom, pop up, right? And then notice what we start to do. We start to create more liquidity, more equal lows, right? And it's just us rinsing and repeating. So over here, while we were creating equal highs to then push price up, this is what we're doing. We're creating equal lows for us to sweep. And look at where we're creating these equal lows. Right above these previous equal lows, right? We're literally creating more and more and more and more liquidity. So that's why the 50% of that institutional area, like I said, is a very poor spot to enter most times, especially on more volatile pairs. Like Forex, it's not so bad, depending on what pair, but for the most part, like crypto and gold and indices, yeah, you don't want to be doing all of that because your stop loss is going to be fat, right? So just looking at price continue to develop, right? It's like, all right, cool, right? We created liquidity on the upside. We created liquidity on the downside. So notice how we sweep up. We capture some of the equal highs that we made, right? Key levels are not necessarily just going to be liquidity, but liquidity are going to be your targets. Like liquidity is going to be where you're going to be looking to ideally like take partials or take profits on your position. So if you see, like, let's say for example here, right? So we see price developing. So let's say price is able to come back down to this area in here. And let's say even if it doesn't, let's just use this for an example, right? So let's say we bought in here, right? If I bought it in here, right, to me, where am I going to be looking to really take profit? Well, for me, I'm going to want to see this previous sell area that I was looking to get into, right? I would look to see these equal highs captured. So for me, right, liquidity is just going to be where you're taking profits, right? Where you're closing some of your position, where you're paying yourself. That's where you pay yourself, right? When liquidity gets captured. Because one fundamental to always keep in the back of your head is the market is not going to really run away unless it captures money. Like there needs to be money behind the move. Think about money as the gas, the fuel for the market. So imagine the market is a car, the liquidity is the gas. It needs gas in order to move, right? So you need to understand that there needs to be liquidity generated and liquidity built up in order for us to move up or down, right? And that's why it's no coincidence why we create liquidity in certain spots, right? So when we sit here and we look at this, right, like I said, it's no coincidence that as soon as we get up here, right, we start to fall over. Why? Because we're pushing into that area of liquidity. What we're starting to do now is almost create more liquidity, more sell side, right? So if we see price, right? I don't know how this ended up getting down here from the 15 to 30 minute, but as we can see, look at the 50%, right? Gets swept. And notice where we come into, right? That area where nobody is looking to fucking enter because they're scared. Why? Because the stop, literally, the area that they were looking to buy off of just got swept completely. Nobody is looking at those areas. But notice how from the 100% to the 110%, if you just played an entry within that area, you would have had the most disgusting entry ever. That's how I get my entries, right? When I'm looking for long-term seasonal plays, this is what ideally I'm looking for. I don't like to get into the middle of ranges, and it's like, when I do get into the middle of ranges, it's like, that's when we end up getting clapped, right? Because if we sit here and we look at this from now, all right, cool. Let's say you were scared to get in that particular area, right? So price, perfect, comes into this area, gets that reaction that we look for. Now if we go to 3 minute, 5 minute, what we're going to try and look for is smaller time frame breaks of structure, right? So initially what I would want to see is a break of structure above here. But more importantly, you're going to look for insufficiencies towards the downside. So ideally, to me, right, within us kind of breaking up to here, in my eyes, if we broke above the 5 minute there, that would be perfect. Like that would be even more confluence. But I would still take this if we came and filled this down part first, right, for the buys. With my stop loss below the low, right, to be safe. But ideally, I would be looking for that. Why? Because it's an immediate algorithm fill, right? So it's immediately just something in my eyes that could potentially be targeted, right? So if we look to see where price comes, it's like fucking clockwork every time, right? So it's like we get a little bit of smaller time frame accumulation, it looks like, above this area, right? So just notice how it's sideways, 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 and then pop! We finally get that one sweep down, right? And like realistically, that came back into our same area. So it's like, let's say we just had the same area that we initially missed, right? Because let's say we just weren't paying attention. It happened way too fast in here. We missed it, right? Now what we're going to be looking for is smaller time frame wise for us to come back and tap back into that area. So notice how we come back and we tap here. So now this is where you get crazy risk to reward, right? Because as soon as we come back into this area, you have to understand the only reason why we're coming back in there, right, is to remove and lessen previous sell orders that were in there. So understand, when we sold off in here, right, and then push back up, the reason why we came back down is because the banks are removing the sells from here, and now they're starting to sell a little bit higher, right? So in terms of where they have to return price back to, right, they're not going to have to come all the way back down there. Why? Because they already removed and lessened some of the sells, because they have to sell to then buy, and then buy to then sell, right? So if we sit here and we just look at this, right, and let's say we position ourselves, right, in here, stop loss below the low, right, looking for the same target, right, liquidity right here, right, not even anything higher, just liquidity right there. That's a 1 to 14, right? So if we really sit there and look at price, right, it's like clockwork. Notice how we come back down, tap this. Why did we come back down and tap there? Because there's an insufficiency, right? So it's like every single time you think price is going to leave you, it's never going to leave you. It's just going to come back, right? But you just have to know what you're looking for when it comes to positioning yourself, because a lot of the times, right, people are not going to be looking for the 110% of a candle. Like this right here would scare them to be playing buys here, because it just wouldn't make sense fundamentally. A lot of you guys would have looked for sells, right? So this is why when I say institutional areas are going to vary on different time frames, because it's like our institutional area here on the 5-minute is a little bit different than what it was on the hourly, on the 15-minute, right? So institutional areas, like I said, are going to be validated based off of just those additional factors, right? Structure, liquidity, right? Just insufficiencies in the algorithm that we have. So in terms of that, really what I want everybody to focus on this week is institutional areas. So what I want you guys to do is start marking up, right? Go to the 15-minute, 5-minute, 30-minute, hourly, whatever time frame, and I want you guys to drop in the bootcamp chat, if you guys are in there, just drop 3 or 4 markups with only institutional areas and liquidity, right? So just give me pockets of money and give me those last up moves before the down moves. And I'll give you guys feedback, right? And ideally, I'll help you guys out. But yeah, if you guys need anything, the last couple of days, like I've just been organizing a few things for the camp, so I'm excited for like the next couple of weeks, right, to see what's up and coming. But I'm genuinely excited for a new month, right? It's April. Like I said, I expect a lot of volatility in the markets, right? Already gold has dropped like 100 points. The market's been open for like an hour and a half, right? So what I expect even on gold too, I expect us to really like I said, I expect us, whatever falling off we get to start the month, it's amazing. Like I told you guys that on Friday, that's what I wanted to see. I wanted to see us sell off to start the month, or just increase volatility. I told you guys Sunday was going to be crazy, and already Sunday market's been open for an hour. We've already moved more than EU is going to move for the whole week, right? So we really have to sit here and we have to just be patient, because obviously by New York session, even if you miss whatever entries are coming today, I really think we're going to get a little bit of retracement, just because we hit 2000 being like that whole level. Like we haven't been to it in a while. Like it's been like a year and a half. I think it makes sense to get a little bit of retracement to start the month. But in terms of that, I'm going to drop a couple charts in the group. Just I'm gonna go mark a few things up, and ideally I'll send them out to the camp for you guys today. But like I said, today was gonna be more of a lesson in the aspect of going through kind of day one of the boot camp when it comes down to institutional concepts, right? And just being able to position yourself. So think of this as like episode 1 in terms of just how to mark up a chart better. Well, we'll call this series How to Mark Up 101, right? Not like a noob. Emphasis on not like a noob, right? Because, my mentor, right? Jordan Morgan, that boy, not a noob, right? So, yeah, I got the same business number, the 507-333. So shoot me a text. If anyone wants to lock in, like I said, now is the time, family. But I appreciate everybody that tuned in, right? If you guys got value, go drop it in whatever chats you guys are in and let them know maybe what you learned, what you took away, right? I'll go ahead and upload this video on YouTube a little bit later today. So if you guys wanted to go ahead and study this, you guys can. But yeah, I love and appreciate you guys. I'm going to catch you guys next week, Sunday, for next week's episode. With that, family, I hope you guys have an amazing Sunday night.